Hey guys, Shelby Mathis here, and today we're going to talk about why renting is your ticket to wealth. I know it's a controversial topic, and I get asked all the time, should I rent or should I buy? So I'm going to give you guys a few tools that you can use to decide whether or not renting is right for you or whether it's the time to buy. So let's jump right on in. Number one, about 70% of the wealth of the United States is owned by the top 10%. The reason I bring that up isn't to say like, hey, we should have class warfare and it's not fair, because the reality is the bottom 50%, which owns about 2.5% of the total wealth, is doing things that they are being taught and being told, or better yet, that they're doing things that they don't know any better, or they're being misguided. And I want to clear up one of the areas that I see so many people get hurt on, which is going out there and overspending on a home. Now, I'm not going to get into all the ratios to use if you're trying to decide how much home you can afford. Instead, I'm going to give you an easy tool to use to decide whether or not you should rent or buy based on that specific property. And I'm just going to call this the 5% rule. And here's how it works. If you come up to a home, and I'm just going to use a round number, let's say that I'll use real life. I'll use real life and give you guys an actual example that happened to me. When I moved down to Las Vegas in 2007, I came from Seattle, moved down here to Vegas, and the housing market was going nuts. This is just before it got absolutely creamed and we had the Great Recession. At that time, the neighborhoods we were looking at, houses were going for about $1 million. And we looked at a house and said, oh shoot, they want $1 million. And I was like, that's nuts for what we'd be getting. There's no way. It looked way overinflated. There was too much exuberance. There was too little supply. Just everybody was going, they wanted to buy all these properties and they never ran their numbers to figure out whether the rentals would even support it. And let me give you an example. That house, I could buy it for $1 million, but I could rent it for $3,000 a month. And so I looked at it and said, all right, there's about a $200,000 down, and then I have to make a payment. Here's the 5% rule. It's going to cost you about $50,000 a year to own that home. And for those of you guys who like doing calculations, it's going to be the property taxes, the insurance, the cost of repairing and maintaining that home, and loss opportunity if you have down payment put into it, or if you're not, some of the mortgage and the difference between what it would have made it as an investment. So the easy back of the napkin calculation is, can I rent that house for less than 5% on an annual basis? So I could rent it for $36,000 a year. That's obviously less than $50,000. So the proper thing to do would be to rent that house rather than buy it. And I was in a situation where I could have done either. What I chose to do instead was take what it would have been the down payment, and I used it to buy rental properties in Vegas in another area that were little cash flow machines. They weren't in the area that everybody wanted to live. They were in an area that was working class, that was still pretty reasonable, and the rents were decent. And then the recession hit. This property that was $1 million could have bought it for about $250,000 to $300,000. Values went down that far. On average, I think our values went down. We were the worst in the nation, was about 75%. So it's keeping right in line. I could have purchased that house for a fraction of that $1 million. Then it would have made sense, because when you're buying on something called cap rate, you're buying based off of what net operating income is divided by the fair market value would give you your cap rate, and you can do the reverse calculation saying, hey, if I want a 6 or 7 cap, I can figure out what I would be willing to pay for that property. And you're going to get pretty darn close to the numbers that actually hit where the investors came in and started buying up those homes. How do I know? I was one of those investors, right? We started picking them up after they got smushed down that were in line with what the rents were. In this particular case, I avoided a major hit that would have affected me by simply renting instead and investing that other money. That other money, by the way, went into other rental properties, which to this day have about quadrupled in value. And the rents did not go down during the recession. The rents stayed the same and actually started going up because more people needed rental properties. It's funny how that works. And so as a result, not only did I not get smushed during that recession, but I also managed to make money during that recession. And I'm going to put it to you guys a couple of different ways. So I'm just going to give you that rule of thumb. So let's use that as another example. Let's say you're looking at a house, 3-bedroom, 2-bath, about the median price, a little bit more maybe. $500,000 is what I could have bought that house for. And you're looking at these houses, but I could rent it, and let's just use the 5%. I could rent that same house for $2,000. I'd probably rent it. That same house gets rents all day long at $4,000. I'm probably going to buy the house, right? I can figure out, can I rent it for less or 5% or less? So that's what I'm looking at. Can I be underneath that amount? Because if the answer is yes, then I should rent it and invest the difference. And if the answer is no, then maybe I should buy it. But I'm going to put 2 caveats on if you're going to buy a piece of property. Here they are. I see people that, and they use their house and they say it's a source, it's my biggest asset. And I have a problem with that. Because the way I define an asset is it's paying me money. Now, we all have a certain amount that we have to live off of, that we need to live. So some of you guys are going to say, well, all houses then would be a liability. And I would say, yeah, you're probably right. But it's okay if it's a liability that I would be paying anyway. What would be the amount that I'd be paying for my housing? Maybe it's 25%, right? Maybe I pick a number and say, this is what I will allocate for the cost of my housing. I'm always going to have it, by the way. Right? Just because I bought this house doesn't mean it, and maybe I bought it all for cash, doesn't mean I don't have those costs to repair and maintain it and insure it and pay property taxes on it. I still have those costs. This is what trips people up. About 40% of the homes right now are owned outright, a lot of it by older adults, and they're struggling because insurance costs are going up, property taxes, some cases are going up, depending on where they live as to whether they have some safeguards against it. And repair bills are going up because inflation has caused everything to get more expensive, and they suffer as a result. So I always look at it and say, here's what I need to be able to live off of. But a house in and of itself is not an asset to me. And some people look at it as their piggy bank. And those people get in trouble because they start borrowing against it thinking, oh, I got $1 million house. And by the way, average equity in a house right now in the United States is over $300,000 as we sit here today, which means there's a lot of tappable equity. The tappable equity in a home is about $200,000 on average. So there's going to be a temptation if interest rates start to drop for people to start spending frivolously or by using their house as their piggy bank. That's where they get in trouble. If you start borrowing against your home and you're not investing that money in assets, in other words, you're not getting a greater return than what it's costing you, then you have the potential of having a dire circumstance, right? Then that's where in 2007, 8, 9, and 10, people were underwater in their homes. They could not stay in their homes. Interest rates started spiking up. You had all these adjustable rate mortgages. You had the perfect storm, and the rents did not support the values of those homes. Right now, rents, they're still a little bit below. Like there is a gap between it. It's not massive, but it is enough to make me nervous that if you put yourself in a situation where losing your job, getting sick could cause you to not be able to keep your home because you mortgaged the heck out of it and you took some seconds out against it because you use it as your piggy bank to pay for vacations or cars or whatnot. Maybe for education for your kids. I mean, I'm not going to judge it. I'm just saying if that's you, then you could end up in a negative situation. I would much rather see people be open-eyed about it and say, this is what I'm living off of. If it's rents, it's easy because you're not tempted. You don't have any equity to tap, but you take that difference. So let's just say here, see that difference? I'm just going to round it to say it's $1,000 a month. I know it's not quite 1,000, it's a little bit more. And I had a reasonable interest rate. like the return from the S&P is actually more than 10% historically. And recently it's been even greater than that. But let's just say I put it in a typical investment. And I did that over the period of what I would have paid on the mortgage, a 30-year mortgage. I would have well over $1 million. I'd have significantly more than $1 million sitting there at the end of that period of time. So if all I did was rent and take the difference and apply it towards another investment, I would be better off. Now, I know some of you guys are like, but you didn't get the appreciation in the house. You ended up with $1 million. You paid you end up in the same place. Let's just put it that way. If you are overpaying on that house and the cost of that home is constantly coming out and you're going negative, not only do you get the $1 million, but you're going negative every year. You end up spending more. Like there's this extra, $14,000 a year that you're dumping into your house that's causing you to lose that other opportunity. Even if you have appreciation, even if it goes up in value, and by the way, historic appreciation on homes goes like this. It's not a curve like you would see on a stock market where it's growing exponentially. It grows linearly at about 3 to 4%, which happens to be about the same as CPI, which is inflation, which happens to be the same as your M2 money supply right now. In fact, if you looked at those charts, you'd be shocked at how eerily close the price of homes is to inflation in the M2 money supply. They all are kind of interrelated, right? The inflation is pushing up the value of your house. You need to do better than that. Now, I get that some of you guys are still like, but I want to buy a house. I own my house. I'm not telling you not to buy a house. What I'm saying is, here's the rule to use as to whether you buy or rent that house. And then there are some tiebreakers, right? If I'm starting a family and I plan on paying off my home and I want to be able to live that's my forever home. I'm going to be there for at least 10 years. Buy that house. If you're underneath it, the problem that I see, and I've lived this because I've moved a few times, is that when you move, it costs you 8 to 10% of the value of the home with the commissions and the cost, plus you have movers and all this other fun stuff, and there's taxes. There's all sorts of things that come into play when you sell a house. I have to get new furniture, doing this, moving stuff, if things are breaking. All that has costs associated. So it's about 8 to 10%. So every time I sell that house, if I'm moving like a typical American every 3 or 4 years, then I'm throwing away the appreciation that I got. I did not receive it. I'm lying to myself. I'm doing a forced savings plan sometimes. And then other times, and I've seen this because my family did this, is they use it as their piggy bank and they use that HELOC or home equity line of credit, or they mortgage the property to live off of, and then they get into trouble as they get older, where all of a sudden that's a pretty big bill to be paid, and they have just enough coming in to cover their expenses, and they didn't anticipate, oh, wait a second, that mortgage never went away. I thought I was going to pay it off in 30 years, but I didn't. Instead, I continued to borrow, and I put myself in a negative situation. So those are the principles that I want you to walk away from today. If all you do is walk away with the 5% rule, and at least you could say, is this crazy? Because there's far more extreme situations than this, where you're looking at it going, hey, should I buy it? Here's the house in the neighborhood. It's $700,000. What would it rent for? I could get it for $2,000 a month. There's no way in heck I should be buying that house at that price. The rents are never going to support it. If we end up in another recession, or if you're ever in a situation where you can't afford to stay in the house and you have to rent it, you need to be in a situation where it can help cover that cost. Or if you have to move, hey, you get the greatest job offer ever, but you're in a bad housing market, you can't sell it. You need it to where the rental market will support your price, so you're not sitting there holding a big liability. These are the things. Simple rules like this will keep you from making that negative decision. And on the same token, while the houses grow historically on a linear scale, investments with compounders grow exponentially. This is when I say compounders, then we're talking about if you own real estate and you're renting it, and you have the rent coming in, the rents are going up, the appreciation, The rents are paying off the mortgage. It's all going to end up coming back into your pocket. You're growing exponentially. Or if you're talking about the stock market, why does the stock market, the S&P get such great gains? Because those companies, they're reinvesting the monies, the profits that they're making, or they're paying it out to you as in the form of a dividend that then you reinvest. These are compounders. Or if you're smart and you know how to do covered calls, you're able to get additional revenue, or cash secured puts, you're able to do additional revenue streams on that, and you're starting to hike this up, and then it grows exponentially. You don't get that with your house. The house, you don't have a compounder unless you're renting out rooms in the house, which I do have clients called house hacking. You can actually do that, especially if you ever find yourself in trouble. You might say, I'm going to rent 2 of the rooms out, right? As you get older and you say, like, oh, shoot, I need some extra money. Well, all right, now you're going to have some roommates. But those are compounders. Those are the 2 graphs. What they look differently, you could go test it yourself. Go try go try the S&P and then compare it to the value that homes have grown. We're kind of spoiled because the last 5 years we saw some major increase in home values. That's because we saw some major increase in inflation. Everything got more expensive and it pushed those values up, which is great, but that's not the rule. The rule is linear growth, consistent with inflation. You're going to do okay. You end up owning your house. It's great. You don't have to cover that expense if you have that house. You're always going to have that 5%, the cost of repairing it, the cost of insuring it, the cost of paying the property taxes on it, the cost of just maintaining a house and so it doesn't fall over, right? There's always going to be those costs. Those don't go away. And I just say, when you compare that to your rent, you can do a side by side and say whether you're better off doing that rental. And I would say for a lot of people, the United States is weird. We really focus on that home ownership. Other countries, not so much. And then they say, we're going to be a nation of renters. And I say, I don't think we're going to ever be a nation of renters. But I do believe it makes sense for some people at certain times of their life to absolutely rent. Sometimes it's blatant, and you're saying to somebody, what are you doing chasing these housing prices? Don't do that. Rent for less and invest the difference, and you're going to be better off in the long haul. I hope this helps some people that are on that line. Do I rent or do I buy? Here's a simple rule, that 5% rule. Share it with anybody you want. Like and subscribe, guys. I really need you to also put some comments, if you can, as to whether you've experienced this and whether you believe that I'm all wet or whether you actually agree with that strategy. I really appreciate that. Good luck to you.